I'm getting a lot of calls this week about what to do if you can't afford your mortgage payment. And that's a big possibility for a lot of people. I mean, obviously, nothing was wrong with March's payment, but as we go forward, there could be problems with April or May, or we don't know how long this will be, that some industries will be completely shut down. So I wanted to go over the difference between a forbearance and loan modification. They're very different, but people tend to confuse them. When you sign your loan documents, there's a paragraph that I point out to people all the time, and it's an actual paragraph that talks about, what to do. Well, a paragraph that explains forbearance, and that a lender, if they give you a forbearance, doesn't have to do it again, and they are not forgiving payments. So most people don't read their deed of trust or their mortgage documents when they sign, unfortunately, but I go through each paragraph and just give the Reader's Digest version. Clients who have signed multiple loan papers with me kind of get tired of it, and I'll give them permission to not have to listen to the explanation, but it's pretty important, and now people are searching for their loan documents and trying to figure it out. So I thought this was an important time to talk about forbearance versus loan mod. A little over 10 years ago, when we had the mortgage meltdown, we saw a lot of loan modifications, which is loan mod is short for. So this is different. So a forbearance, some people might have heard of it with student loans. When you graduate and you're supposed to get a job right away, which most people don't experience that. So most student loans have a forbearance clause that says you can delay starting your student loan payments for 6 months after you graduate until you get a job. So some people have heard that word forbearance. So I like to call it skipping payments, but you're not really being forgiven the payments, you're just delaying them, okay? So an existing loan can have current payments delayed or put on the back end of the amortization or onto the loan balance to give you some breathing room. So you're not changing the terms of the loan, you're just taking 2 or 3 payments, whatever you and your lender agree to, and you're putting them on the back end of the loan. So let's just say you're in payment 120, the 10th year of your loan. So you have 240 months left of your 30-year loan, and the lender decides to give you delay 2 of your payments. Then those 2 payments are going to be put on the back end. So you really have 242 months left, not the 240. Now, let's say you sell or you refinance, those 2 payments will become part of the loan balance due. In other words, they're added on top of whatever you owed in year 10 through regular amortization. Those 2 payments are added on top. So let's just say let's say your payment was $1,000 and you skip 2 of those $1,000 payment. Don't we all wish here in California we had $1,000 payments? But anyway, just for math's sake, and let's say you owed $150,000, they would put $152,000 on your payoff letter if you sold or refinanced. So the rules on who gets a forbearance normally, the rules on who gets a forbearance and what the process will be depends on the agency that your loan is covered by. So most of us probably have Fannie Mae or Freddie Mac loans. There are FHA loans, which is FHA is part of the government department called HUD, or HUD, Housing and Urban Development. Then there's VA loans, there's SBA loans. So there's all kinds of loans that can be mortgages against your house that are covered by different agencies. So it can be done pretty much to any loan, but in our case, we're talking about mortgages. So that forbearance, we're basically skipping or delaying payments, and we're putting them on the back end of the loan. Now, a loan modification is where you actually change the terms of the loan. So some of you may even have gotten these agreements with your lender. They take an existing loan and they change one of the terms or many of the terms. So it could go from a 30-year amortization to a 40-year. So if you stretch out the loan, the payment goes down. It also was often seen that you would see interest rate reductions. So if you got a loan in, say, 2006, rates were right around 6.5%, 6.5%, and then the mortgage meltdown happened. And so lenders, instead of having a bad loan on the books, they were reworking the loan to reduce the interest rate, which also could, if you go from 6%, I saw a lot of people getting 2% and 3% loans, which at the time seemed so low, and now we're in a market where that's the norm. But anyway, they would restructure the loan to give you either temporarily, like 2 or 3 years of a 2% loan, or a step up. They would start you at 1%, then 2%, then 3%. So over 5 years, you would go to something like 4.5%. But it was to give you a lower payment till you could get back on your feet. And some were permanent. Some people got reduced from 6% to 3% for the life of the loan. Some people, though, were allowed to restructure the payment to where the payment went down, but the interest rate didn't. So they were basically making partial payments as their new regular payment. So for example, let's say your payment used to be $3,000 a month. Some lenders were giving you $1,500 a month and taking that part that you're not paying and adding it to the back end of the loan, and that's called a balloon payment. So anyway, so that's a loan modification. So in both cases, you do have to show financial hardship or some kind of financial event. Often it's a reverse application. You have to fill something in to show your hardship.